basically, the shortage of silver has built up over a long period of time. I mean, if you look at the Silver Institute's estimates of supply and demand, you can see that it's been supply deficit for the last 5 or 6 years, and it's in supply deficit this year, and the difference is always made up on the Silver Institute's calculations by drawing down on investment stocks, what they call investment stocks. We've come to an end of that. And, the thing that makes it so difficult, I think, is you've got this very limited liquidity. The vast majority of silver in the LBMA vaults is actually for silver ETFs. You look at the big silver ETFs. I mean, basically that accounts for most of it. What we're seeing in the markets at the moment is a squeeze on lack of liquidity. It's very obvious in silver. It's less obvious in gold because you're not getting the high lease rates and backwardations between London and New York. But nonetheless, there is a squeeze in gold because following earlier this year, when masses of gold were taken out of the Bank of England vaults, basically, to arbitrage into New York, a lot of that was leased gold. Because, the principal storers of gold in the Bank of England are other central banks. And the Bank of England has always encouraged other central banks to lease their gold as part of providing liquidity in the London gold market. Now, when you see it actually disappearing out from under the Bank of England's control, you wonder if you're going to get it back. So I really do think that central banks as a whole are withdrawing from the gold leasing market. Now, this is very important because it's been leased gold, which has been hypothecated, rehypothecated, rehypothecated to keep the whole system, sort of swimming along. And without that leased gold, we're going to end up with a bit of a crisis. And the other thing which I was sort of thinking this morning, Alex, is that we've had problems in the past in the bullion markets, but they've never been publicly aired, if you like. Only sort of well after the event, you hear that so-and-so had to be rescued or whatever.
Leasing of gold and silver, when an institution allows use or borrowing of metal in return for interest, has long underpinned the wholesale bullion markets. In the gold market, the so-called gold lease rate, GLR, reflects the cost of this borrowing. When large holders such as central banks pull back from leasing, the system tightens. The lack of available leased metal means bullion banks and traders lose a key flexibility. And when silver is involved, the effect can be more acute because its physical market is smaller and less liquid relative to gold, making disruptions sharper and less cushioned.
There was I can't remember there was a bullion bank way back in Eddie George's days, and I'm going back to I think sort of very early 2000s when he had to sort of disappear off from a meeting or from smoking a cigarette outside the Bank of England because he was a wonderful trader and a really really good guy. He had to go and help rescue this problem. This just doesn't happen now. I mean, we just don't see it. But suddenly, yes, we do see it. And it's all over the press. Everybody knows about, that there's a shortage in the physical and the silver market. I mean, they come up with different conclusions as to how to resolve it and what is likely to happen and all the rest of it. But this is a new thing that's become very public, and it must make it very difficult for the authorities to manage a crisis, if you like. I can't see really how this crisis can be easily managed. I mean, in the past, there wasn't, if you like, the sort of current overall level of indebtedness. You had speculators, if you like, driving prices. But if you look at the open interest on COMEX, the speculators are not there. I mean, this is all short squeeze. And how do you remedy a short squeeze? Well, you supply some physical into the market. But who's going to supply the physical into the market? No, not even the authorities have got it. You could argue that the United States might have some concealed silver reserves, but that's just gone onto the critical minerals list, or at least it's been recommended, so it's unlikely that the US government will come to the rescue of London on this one.
Now we layer in the physical constraints. Silver in particular has seen deep deficits in supply, driven by industrial demand, investment inflows, and limited new production. With fewer bars available to borrow, move, or deliver, market mechanics that depend on fluid metal flows begin to creak. In major hubs such as London, vault inventories have shrunk and borrowing costs spiked for short positions. In short, paper contracts and futures may trade smoothly, but when you need physical metal, the margin for error is thin.
China? Are they going to come to the rescue? I mean, in the past, they have suppressed the price. Of that, there is absolutely no doubt. But it seems to me they've withdrawn from the market. And not only have they withdrawn on silver, but you can see from their policy on rare earths that generally they're withdrawing from supplying needed metals and commodities from the West. So you can see that suddenly, where's it going to come from? And reports that I've had 2 reports in the last few days of enormous demand for silver and gold. I don't know, this is something you could probably comment on, but the dealers in bullion have been absolutely inundated with orders from private clients, from small people, and suddenly, they are just incredibly busy. I mean, I had I was meant to be doing a podcast earlier on this morning, but the people I was doing it with phoned me yesterday and said, "Look, do you mind awfully if we put it off because we're so busy, we just haven't got the time to do it." Yeah. So this is new, and all this publicity is just driving extra demand. People are just getting in because they haven't got any. So they're trying to get into these bullion markets. So coming back to your question, I mean, there is no doubt that what's going on in the markets at the moment is specific to precious metals, driving up their values. But this is against a longer-term background of what's really happening, and that is it's the values of the paper currencies falling rather than the values of gold and silver rising. Though this squeeze is actually changing that relationship quite a bit.
On the one side, you have futures, open interest, and speculative betting. On the other, you have the hard reality of metal stored in vaults, locked in ETFs, or otherwise unavailable. This divergence is increasingly visible. In the gold market, open interest is high, yet the underlying physical flows tell a different story of constrained supply. The squeeze plays out when short sellers or hedgers need to access or deliver metal and find the chain of counterparties or leased stock in retreat. This kind of dynamic tends to intensify price moves, particularly in less deep markets, where a modest flow demand can trigger a substantial move.
I think what you've got to look at is the relationship between speculation and changes in the price. I mean, COMEX is an openly visible market on this one. When you see the price rising and open interest either not following or even contracting, that is a clear sign that the bears are being badly squeezed. And if you look at the level of open interest in gold, it's around about 480,000 contracts, something like that. That's not overbought at all. Yet we've been, as you said earlier, we've been hitting new highs day after day after day. So where's the overbought? It's not overbought. Okay, you look at the RSI indicator, chartists will say, oh, that's overbought and all the rest of it. But, they're looking at the wrong thing. Man does not survive by charting alone. You've actually got to look at the market. So this is a very, very difficult situation for market makers in particular, in futures markets and also in the forward markets in London. I mean, I think in the broader context, what we are seeing is, if you like, the relationship between paper and physical becoming very, very strained. And I think it's a symptom of the end of the fiat currency system. We are beginning to see that the fiat currency system is in huge, great difficulties. Of that, there is no doubt. And fiat currencies don't last forever. They've always got a limited span, and they always collapse, and they always collapse in the same way. They collapse basically because there's just too much debt. The debt just mounts up and mounts up. I mean, the whole point of a fiat currency is you can issue the thing, without constraint. So obviously it gets issued without constraint. So that means there does come a point where the fiat currency can be no more. We've seen, every collapse of a fiat currency is really from that sort of, from the overloaded debt, the accumulation of debt.
Embedded in this metal market stress is a broader narrative, the evolving weakness of fiat currencies and the global financial plumbing built upon them. When debt loads rise and issuance of currency proliferates, the foundational trust in paper money becomes vulnerable. In this context, gold and to a lesser extent silver become symptom and proxy. As one analyst recently noted, silver lacks the backing by central bank reserves that gold enjoys, making it more volatile and risk-exposed. The metal squeeze thus may be a harbinger of deeper structural disorder in credit, currency, and global markets.
And if you like, the dependence of governments on issuing yet more and more currency, because they've done it before, and it's their right to do it, and who dare interfere with us is financing your government. You've got all these sort of arguments in favor of the eventual destruction of fiat currencies. And I think, Alex, that's where we're going. To see what's going on in the metals markets, I think is the first sign of that. And I wouldn't be surprised that this is the first sign of it. Because the problems, I think, in derivatives, we're talking about, quadrillions, really. Well, not quite quadrillions, but we're talking about, sort of $600 trillion notional of derivatives. And, that basically is all built on fiat currencies. And if fiat currencies are coming to an end, this is the canary, if you like, in the fiat currency mine. It seems to me, and it starts with gold and silver and spreads maybe through other commodities and then maybe into foreign exchange transactions, for example, and so on. So, that's where we are, and it's I think signaling that things are going to get very, very difficult for everybody. Basically, the shortage of silver has built up over a long period of time. If you look at the Silver Institute's estimates of supply and demand, you can see that it's been supply deficit for the last 5 or 6 years, and it's in supply deficit this year, and the difference is always made up on the Silver Institute's calculations by drawing down on investment stocks, what they call investment stocks. We've come to an end of that, and the thing that makes it so difficult, I think, is you've got this very limited liquidity. The vast majority of silver in the LBMA vaults is actually for silver ETFs. You look at the big silver ETFs. Basically that accounts for most of it.
For investors, the confluence of tighter physical supply, shrinking leasing activity, and broader monetary stress means precious metals dynamics are changing. A historically high gold-to-silver ratio suggests silver may outperform under the right conditions, yet with higher volatility. Reports of bullion dealers inundated with orders from private buyers underscore how much investor sentiment is shifting. The question becomes, when metal is scarce and paper claims proliferate, who delivers the product when needed? And if delivery fails, what happens to price discovery? In short, the risk-reward is elevated, and not simply because prices have risen, but because the plumbing is less robust.
So the liquidity is actually very, very low, what's actually available. So what we see is authorized participants, as they're known as, the big banks, if you like, who will be listed on SLVs, for example, prospectus. What they can do is they can sell SLV stock for physical. So what they're doing is they're going out and they're borrowing silver, SLV stock from pension funds, insurance companies, whatever, wherever they can get hold of it, and paying a huge, great premium to do it. And actually, it's that there isn't any supply of SLV stock anymore, but they then sell it into the market for bullion and then deliver it, and they're left with a short position. They've got to cover that at some stage in the future. So, this doesn't actually resolve the problem. It just deals with one bank's particular position, short term. It's rather like, payday loans. You run out of money and you've got the bills to pay, and you're not going to get paid until next Thursday or whatever. So what do? You go out to payday lender and you pay 120% or whatever the figure is to, finance your position for 3 days. That's all they're doing. So this is just, storing up continual trouble in the market. I just don't see how this one can really be resolved, because the problem is that all this is going into secure hands. I mean, people are hoarding the stuff effectively. And now, because this is so public, people are subscribing for, guess what? ETFs, silver ETFs, which is reducing. I mean, the silver, the managers of silver ETFs they've got a problem, because they've got to now try and find some silver. And there's very little available in the market. So all these talks about flying silver from New York back to London, I should think most of that silver is spoken for by the ETFs. I mean, when's it going to end, Alex? I just cannot see. This squeeze, I think, has got a long way to go, I must say. I mean, the other thing is that you're looking at a gold to silver ratio of around about, it's just under 80. That is very, very high, particularly if you take the view that we are coming to the end of a fiat currency system. Because the other side of the end of a fiat currency system is the repatriation of gold into its rightful position, which in everyone's common law is final settlement without counterparty risk. It is the true money. And silver has a subsidiary role in that. So we're likely to see the gold-silver ratio fall very substantially. What does that mean? It means the silver price goes up to 100 quite easily. I mean, don't hold me to a particular figure, but, for example. And I think the market is getting the sense of this. And certainly for private investors who feel that they might have missed the gold boat, having maybe taken profits at $2,000 or $2,070 when you remember that was the top of the trading range for some time, regretting it and thinking we've got to get back in. But how do you buy gold at $4,130 when you've sold it $100 or $1,000 or $2,000 below the current level? This is a psychological nightmare for investors. So what do? Buy silver. It's far cheaper. That way you get it back in the ride, with a little bit of self-respect preserved. So this silver thing is actually very, very serious and continuing.